Welcome to Fundamental Trends and Margin of Safety Investing with Kirk Spano. Today we're going to talk about different types of asset allocation and investment decisions, and then cover a number of stocks that we are involved with, as well as different investing strategies. Folks in the chat room, feel free to post questions, and I will get to them in short order. I know it's Good Friday, so we won't make this very long, and should be done in about a half an hour range, which means probably an hour, but we'll shoot for a half an hour. All right, so I know that we have a lot of new subscribers. We have really more than doubled the member base in the last 60 days, so I thank you very much for that. What I'm trying to do, as you know, I'm an investment advisor, and I would like to start doing my research by traveling to visit different companies and managements and see different things. I think it helps to have boots on the ground. I do have a pretty extensive network of contacts since my Market Watch days, so I've got a pretty good telephone and email list, and that has helped me to pick out the stocks on the very short list, which I'm constantly modifying. Looking for about 100 companies that we can use to build our portfolios. A lot of them dividend-paying stocks, but a lot of them more traditionally growth. And I do think the growth is where you make the most money in the shortest amount of time. However, the steady, tried and true approach to beating the market by 3 or 4 points a year comes from a lot of those dividend plays. So by mixing those together, we get a really nice blend. Also, I am putting up the ETF list probably by tomorrow. I have a nice new spreadsheet that you guys will be able to use. I borrowed it from another service and then modified it, and it's a pretty nice thing. So as I get that finished up, I should have a new link Saturday, maybe Sunday, but it'll be very, very soon. So with that all said, go ahead and post your questions in the chat. I've got a few already lined up. I'm going to start with asset allocation. I know a lot of folks, like I said, are new, and so they haven't really heard me talk about this before. Asset allocation, I use a very simple concept that I've modified a little bit right out of The Intelligent Investor by Ben Graham, and that is Warren Buffett's mentor. Obviously, I think everybody knows that. And we know that asset allocation accounts for about 90% of the volatility in your investment portfolio. That doesn't mean that it accounts for 90% of your gains or losses, just 90% of the movement. So selection of your individual securities actually has a very large role in what you actually earn, but the movement, the ups and downs, has to do with asset allocation. And you can see that in the last week or two with technology. If you're heavy in technology, you've really seen some ups and downs. Now, over 5 years, it might not matter, but in the short run, the bouncing around is very destabilizing to a lot of people's perceptions of what's going on and can cause bad decisions. So here at the very start of this conversation, I will tell you, you need to look at volatility as an opportunity, not as something that's scary. You need to look at when the market spikes up as an opportunity to take some profits, and when the market spikes down or a stock or a sector spikes down, an opportunity to build a position if you believe in it in the intermediate to long term. And when I say intermediate term, I mean that 2 to 7 year window. You know, it's not short term, not 1 or 2 years, but you're looking at that 2 to 7 year window where you can understand business plans, you can understand some of the cyclical trends. And I think for most of us, that's the window that we want to invest in. I mean, maybe out to 10 years, but nobody really knows what's going to be going on 10, 20 years from now. You have a broader picture, and we want to understand those giant secular trends. That's part of the investment selection criteria. But you know, our window for investing is that 2 to 10 year window is what we should think about, because that's generally predictable to this point of accuracy, not necessarily precision, right? Precision is laser focus, pinpoint that company is going to earn 50% a year for 10 years. And nobody can do that. But you can say this company is doing very well, or this sector is at the bottom of a cycle and is about to go up for the next several years. Those are the sorts of things that you look for with asset allocation. I'm going to skip through some things here. The core asset allocation for Ben Graham was 50% stocks and 50% bonds, and that was 60 years ago, 70 years ago. I think that it's valuable to think of your portfolio that way, but in general, you'll never have 50% bonds, even if you're 70 years old right now. A bond portfolio is incredibly risky given the interest rate cycle that we're in, coming off of the extremely low interest rates, and the fact that there are significant credit risks, not only at the corporate levels globally, but at the sovereign levels. We have nations that are at some point going to have problems, fall out of bed, have to remedy extreme debt situations, and it'll probably come in the form of either creating more debt via quantitative easing to pay off old bills, or, as I believe, and I've talked about a couple of times, sometime in the 2020s, some country is going to fall out of bed, and they're going to have to just print money, and it'll be helicopter money. It won't be we're going to issue bonds to generate money. We're just going to print it. So the idea that we've printed money to this point is not true. So far, we have issued debt to put money into the money supply. In the future, there'll be a point where we just say, we're going to print off $7 trillion. And that'll be that. And they'll pay off whatever they pay off, and it'll create a one-time inflationary event. And then there will be a big reset. And people like Jim Rickards and others talk about the big reset as a cataclysmic event. Will it be similar to 2008? Probably. But as you can see, 3-4 years coming out of that, we were doing okay. So for decades of poor planning, we will be able to fix it in a 2, 3, 4 year period, especially if there's coordination versus competition and war. So that is the big risk. The big risk is in financial turmoil. Sometimes that creates war, and we have to try to avoid that. In any case, going back to the asset allocation, think of where you are in the investment cycle, and if the valuations of the market are very high, typically you want to dial back your asset allocation to have less in the stock market. On the flip side, if you're coming off of a stock market crash, you want to have more in the stock market. Pretty simple concept. Prices are cheap, buy more. Prices are expensive, be a seller. Right now, we know that we have record high prices in the stock market as a whole. However, I will point out that a lot of that is in about 50 stocks, and some of those stocks have been coming down in the last week. So we're seeing valuations come down in whole, but remember, of the 500 stocks in the S&P 500, only about 50 of them account for all the gains and the valuation stretch. And then across the broader market, say the Russell 2000 or 3000, you're still looking over a couple hundred companies. So you have 80 to 90% of the companies out there that aren't really overvalued. However, they have a hard time finding investors. So therefore, their valuations aren't going to be 30 PEs and 40 PEs and 50 PEs like some of the well-known stocks that have soared. We have to take that into account, that there is a bifurcation in the market. But when we think about asset allocation, how do we want to think about it? Well, I will tell you, I am in agreement with Warren Buffett that your standard asset allocation, after you have your safe money in the bank for emergencies, really ought to be close to 100% in equities. It is unusual for me to have 25% of my money in cash like I do now and be inching towards 50% in cash, because in general, I just know that being fully invested with occasional tweaks to the asset allocation per decade worthwhile. And in this case, we have the double whammy of the favored stocks of the market being very overvalued, and then the unfavored stocks, not a lot of people investing there. And that's going to go on for years until we get that helicopter money and until the bailouts that are coming take form. Now, I'm going to write a paper suggesting a way to handle the bailouts. It'll fall on deaf ears, but maybe not. Maybe we'll get lucky. Maybe I can get it in front of a few people. What I think is eventually going to need to be done is we're going to need to bail out a couple of different groups. First of all, over $1 trillion of student loan debt is at risk of going into default. And more importantly, that student loan debt prevents all of those people from being full participants in the economy. And that's tough. Those are educated, skilled people who are working, and they're basically hand to mouth. If we can free up their budgets, at least partially, to spend again, and most of these people are Xers and Millennials, but there is actually a pretty large portion of baby boomers who still have student loan debt. But between the Xers and the Millennials, if we can free up some of their money, then that is probably good for the economy. And one thing to keep in mind that I will just throw out there for you, and I know I'm moving around here, is that the Millennials do have higher student loan debt, and I know that we get these arguments that, oh, well, that's on them. Well, at the same time, they're earning less, inflation adjusted, than the baby boomers did because there's price deflation in wages that has occurred over the last 35, 40 years. So to give them retroactively a less costly education through some sort of partial or full student loan forbearance or outright forgiveness or some way of working that out, I think is disingenuous. I think that the Millennials have caught a bad deal economically, and the Xers somewhat. My generation's doing okay because we're starting to get all the management positions, but the Millennials, that age group of 20 to mid 30s, they've really kind of gotten screwed by the older generations, particularly the boomers and the silents. Really just haven't left them with as much earning potential as they should have had, right? We want every generation to live better, and the Millennials are a generation that are facing the very real possibility of not being able to get that. Somebody says, are they skilled? Yeah. The Millennials are some of the most skilled people out there. The problem is that their skill set is not always a match for the old economy. So where they have pushed into new economy jobs, and most of them are actually earning pretty well. I don't know if you know this, but the Millennials save more as a percentage of their income than any other generation ever. So this idea that they're not saving is wrong. Now, do you have that 20-25% of them that are just chronically behind, living in basements, the cliche, the stereotype? Yeah, you do. You have that fifth of the group, but that's not much different than, I'd say, the Xers or the baby boomers. You know, you start with the hippies and you work your way back down through the slackers and now to the Millennials. There's always that fifth of the population, that bottom 20% that's not going to do very well. But the Millennials in general, and you can look at any statistical representation, you can look at almost anything, and what you will see is that the Millennials, in fact, are a pretty darn good generation, but they've walked into harder circumstances than any of us who are older than them. And that's just a fact. So, you know, we've got somebody saying they got screwed by their decisions. No, bullshit. You know, I'll just call that for bullshit what it is, John. That's bullshit. The Millennials in general have gotten educated. They are skilled. Now, can most of them crank a screwdriver and put together something mechanical? I don't know. You know, I know that there's a little bit of a shortage in the in some of the mechanical spaces and in the machining. I forget what it's called exactly. I got one right down the tool and die shops. But the reality is that the Millennials, you can look at any statistical representation, and they have exceeded on education, and they have been trying to work. And for the most part, as a percentage of their income, they are saving more than you or me or anybody older than us did. And I say that knowing that I have very few millennial subscribers. Almost everybody's an Xer or a baby boomer. So this idea that the millennials are a bunch of slackers and they don't know what they're doing, and they do suffer from inexperience, and every one of us suffered from that too. So I will tell you, if you read The Fourth Turning, you will find out that the millennials correspond over a very, very long period of time. There's 4 generational cycles, and the millennials correspond to a hero generation very similar to the World War II generation. So I would encourage you to read The Fourth Turning. I'll even put that up here for a second. I think it's that important. And Strauss and Howe. Howe is still around. I see him out there. But fourthturning.com, read the book. It's a great book. If anybody saves the world, it's going to be the millennials, because frankly, who else would it be? It's not going to be anybody older, because we would have done it already, right? So, I would say just keep some of these big picture ideas in mind. The whole crapping on the millennials, you can crap on the bottom 20% of any generation. So when you do your asset allocation, if you believe the market's very overvalued, you probably move 50% of your money over into cash and or short-term bonds. And that's just kind of an ebb and flow sort of thing. It's not sudden. You don't wake up one morning and say, I'm 95% stocks and say, I'm going to go to 50% today. No, you look for the rips in the market, for those run-ups in certain stocks or sectors, and you respect the rotations. You say, okay, semiconductors went up 30% in this quarter. I'm going to sell some. Or oil went up 30% this quarter. I'm going to sell some. Or healthcare dropped 30% this quarter. I'm going to buy some. But, you do that ebb and flow. Now, it's my opinion that most investors, depending on where you are in your risk tolerance, where you are in relation to retirement, things like that, should be between 25 and 50% cash right now. And there's some very complex reasons why. It's not just the overvaluation in the markets. It's the fact that the algorithms drive the trading and the cycles. And you just can't keep up with the algorithms. So you have to just get out of the way and wait for them to give you an opportunity, which is why, and I'm going to write a whole article about this too, because people are asking about it, why I use limit orders, right? I don't just wake up one morning and say, I'm going to trade something. No, I have a plan. And the market doesn't always come to me, but I know what I'd like to own at certain prices. So if you take a look at the option trades that I put out here recently, the April options, you'll see these are not prices that we can get right now. But on these particular contracts, and you can fudge with these contracts a little. You don't have to be precise. Sometimes, maybe the $8 to $9 to $7, within $1 or $2 of these strike prices, depending on where the volatility is, you can adjust these options just a little bit. But I'm looking for certain prices, and I'd say probably half of the time, sometimes 2/3, sometimes 1/3, but in a lot of months, I'm not going to get these prices. Why? Because the market moves the other direction, or a sector moves the other direction. GameStop, man, I know that we all hit that one. So, the folks who sold the GameStop $14 strike price, I'm sure got their $1.40. I haven't looked. I know a couple of people said they did that trade. So I bought a little bit more GameStop. I just held my nose and bought the stock because they have a dividend, and we'll talk about that company coming up. So several people specifically asked me about this right here, the September put at 280 strike price for the S&P 500, and they're saying, well, that must be a typo because right now that price is like 18 or 20. And I was like, I know. So why is this up here? Because if the stock market rallies and goes up 20, 30 points on the S&P 500 over the next couple of months, then all of a sudden this September put could drop to $2, right? And at that point, I'd probably want to own it because it's near the top of a trading range. All right, back to asset allocation. So right now, depending on if you're highly risk tolerant, you're willing to use the volatility on a regular basis to make a couple bucks here and there, then maybe you only have about 25% of your money in cash, and you're selling a lot of puts against it, that are out of the money. But if you're somebody who's like, I can't afford a 30% drop in my asset value if the algorithms go crazy, then you should be holding a little bit more cash and just waiting for one of those opportunities. And it's okay to earn a little bit less while you wait for an opportunity, so long as you're not doing it for years and years and years. So, all right. Not going to spend a lot more time on that. You'll be a little bit more conservative if you're what's called an intelligent investor, defense first. A little bit more aggressive if you're an enterprising investor, offense first. All right. So let's move on to how we pick out stocks and ETFs. Yeah, we'll talk about options a little bit much more in a minute. All right, so 4-step process to picking out investments. And I'm not going to spend a lot of time on this. I know that we've talked about it before. I'm going to start putting out these core 4 reports eventually. The GE one's almost done, but they take a lot of work. I'm going to use bullet points instead of pros to get them done faster. We start with the big secular trends. What parts of the economy do we want to invest in for the long term? And I think that some of those places are obvious. I think clearly the Internet of Things, the smart everything economy, as I've called it, is where we want to be. I think in the next several years, a position trade is in energy. And I will tell you, these oil investments that I have, I do expect most of them to go up between 50 and 300%. I do. However, it might be the last time ever. Because the changes in technology on alternative energy and electric vehicles, the fact that lithium production is starting to ramp up, we're going to see electric vehicles in the next decade. I was just talking to somebody who drives an EV, one of the Nissan Leafs, which is surprisingly fast for a crummy little car, is looking to replace that. And we were talking about the Toyota Camry hybrid. Here you have a hybrid vehicle, and I don't understand I haven't looked into the mechanics to understand it enough. I don't know if it's an engine and a motor, or if it's a motor with a range extender generator. But the Toyota Camry hybrid is about $1,000 more than an internal combustion engine vehicle. It's only $1,000, and it gets 50 miles to the gallon plus. So, why wouldn't for $1,000 you increase your mileage by 60%, right? So I think the hybrids, and I talked about this on Market Watch years ago. I thought the hybrids were going to be the place where the big money was made, not necessarily in pure EVs. But I think it's going to end up being a split. I think your bigger vehicles will be hybrids. I think your smaller vehicles will be EVs. I'm just guessing on that. Although Tesla is starting to prove us wrong on the trucks, and Volvo is talking in that direction too. So maybe we do go to a pure EV fleet over time. But I think hybrids are going to have a place. We'll see. In any case, you take a look at the big secular trends and you figure out where you want to be and where you don't want to be. I think one of the big mistakes that people are making is that they want to be overweight in healthcare because of the aging population. I think that's probably wrong. In fact, I think there's a massive bear market in healthcare stocks coming because since the start of Obamacare, you've seen all the healthcare stocks go up a lot. Why? Because their margins have stayed thick and they have been able to basically grow the healthcare system, which is, we're on the verge of bankrupting, a lot of systems in a lot of countries. So governments, and this is where you go into the next step, governments are going to start getting involved in the things that their federal budgets are spending money on. In the United States, which provides a lot of the money for propping up the healthcare system globally, because we overpay for our drugs while everybody else gets them cheap, that's going to change. And I don't think anybody here would doubt that we might see a tweet from the president that says, drug costs are too high. We have to change that. We have to change it fast. These companies are gouging. They should be ashamed of themselves, right? Who can think for a minute that you can't see that tweet in the next election cycle, right? And then people will jump on it, the Democrats and Republicans. So I think that there's going to be a major shift in government policy that affects healthcare, and I don't think that you're going to see the healthcare investments do as well in the future as they have in the past. And in fact, I've speculated on about 7 or 8 companies that I think can drop 50% in their stock price, including United Healthcare. You can tell me I'm wrong all you want, but take a look at their valuations. Purely on valuation fundamentals, they can drop. But what if their earnings stop going up? What if their earnings roll over? What if the government has an action that causes their earnings to drop 20, 30, 40, 50%? I would not put that past them. So secular trends moved right into government and central bank policy. One of the big things in central bank policy right now is that we have to understand that the Federal Reserve is starting to tighten. Remember the phrase, don't fight the Fed. We have to watch to see whether the Fed really gets hawkish. If they do, that's bad for the markets and probably bad for the economy. The economy is still very fragile for all the deflationary reasons that we've been dealing with the aging demographics, the big global debts, slowing global trade up until very recently. There's a lot of massive long-term trends, including the deflationary impact of technology. Now, technology is one of those interesting places, right? It's supposed to add productivity, but at the same time, because it's taking jobs away, that's deflationary. So we haven't overcome that in the last decade. We've really had a decade without much increased productivity, and that's because of the offsets on one side and the other side of the technology equation. Move into the fundamental analysis of a sector and or a company. Really, we're looking for comparative advantages, and we're looking for catalysts that the markets don't recognize. And that really is where a lot of money is made, is if there's a narrative about a company or a sector. For example, let's talk about energy right now. The narrative out there is the whole lower for longer narrative on energy, and I just think it's wrong. I think that we're going to go through a period where supply is controlled enough that rising demand creates a plateau where supply and demand are roughly equal, and for about a decade, give or take, before demand really falls off due to EVs in 2030s. That's when different things will happen. But I think that you're really going to see a lot of money made on that discrepancy when that narrative changes, and that narrative will change. Going back to the millennials, though, they might throw a little bit of a monkey wrench in there because they're not generally too prone to investing in fossil fuels. So again, you have that problem where you have energy companies that are seeing increasing earnings and increasing cash flow right now, but still having a hard time finding investors. It's interesting. And that flows right into price trends. You have to respect the investor psychology, because it doesn't matter necessarily if everything else is on your side, but you just can't find buyers. People just don't want to buy the stock or get into the sector, and that could depress prices. So we need to have all of these things on our side, or at least not against us, to really want to invest in something. And that is why my results have been pretty darn good over time, is that I say no to a lot of investments. Whereas people talk about indexing and owning a little bit of everything and just being part of the growing economy, well, if the growing economy is going to be 2% a year forever, the slow growth forever concept that I've thrown out there, because of the demographics, because of the debt, because of the technology offsets, do you really want to invest in the whole economy, or do you want to pick out the best parts and put the other parts on the side? I think that's an important question. Somebody posted on Twitter that Kid Capital or something he calls himself, that he was basically talking about index investing and talking about getting wealthy as an index investor. And I chimed in there. I said, nobody gets wealthy as an index investor. And that's absolutely true. I'm going to write an article on that one too. All kinds of great ideas if my fingers would work fast enough. You cannot get wealthy as an index investor. Can't be done. Can't be done. Because you will basically grind out a 10% return over time, and you'll have to save a ton of money to end up being a $2, $3, $4 million portfolio when you retire, which if you're 35 or 40 right now, I mean, I don't know that 4 million is enough. 4 million is the number that I'm trying to get to. I'm on my way. I'm 48, but for somebody who's younger than me, they might be thinking, they should be thinking, I think 6 or 8 million, just because of the inflation that we're going to get as a function of monetary policy. Not necessarily because there's other inflationary forces, but the monetary inflation will be used to offset the deflationary forces, and it'll screw up asset prices and income generation and things like that. So when we invest, think of these 4 things. Once you have your asset allocation ideas in mind, what big trends do we want to be in? What are the government and central banks doing? What is the real fundamental value? Hidden catalysts, things like that, comparative advantages. And then the price trends. Can't find a buyer. Maybe you don't want to get involved. All right. Can you provide links to how to come up with strike limit for short puts? Links. I don't really know what you mean by links. Yes, so support and resistance. I use that all the time. So let's take a look at. All right, so let's talk about options. Somebody asked me why I use options the way I use options. I sell cash secured puts on a regular basis. And I do that because it's less risky than actually buying the stock. How can that be? Well, the reason that can be is that we are getting paid a premium to buy a stock that we already want, but at a lower price generally. So if we take a look at the options, Antero was trading at about $20 a share when I wrote this. We can sell a May $20 put, okay, and somebody will pay us about $1. Excuse me, I have to find a cough button. So for the next 6 weeks, we've got that dollar in our hand, and forever we have that dollar. If the price of Antero is below 20, come May, 3rd Friday in May, we'll end up owning the stock. It'll get put to us at 20, even if it's trading at 18 or 19, and we have $1 in hand. Now, what is the alternative? The alternative is we could buy it today at 20 and not have the $1 in hand. So are we better off owning it at 20 today with no dollar, or owning it at 20 in 6 weeks with the $1? Pretty simple. So you're taking the equity risk minus whatever you get in premium. Okay? And if there's, if you're writing the put a little bit out of the money, a little bit below today's price, then you can, you're getting that margin of safety as well. Now, take a look at a company like Sierra Wireless. I think this is a company that we really want to own. Stock has been trading in the 16s, but I still sell a put at $17.50. Why? Because I really kind of want that stock to get put to me. I want to own that, so I don't want to have to rely on it going down. By selling the $17.50 put, which is a little bit in the money right now because the stock's trading in the 16s, I can get about $2.50, And I think a lot of us did get 250. I think it's at 2.25 right now, but a lot of us got 250 for that put. That means that our net cost on Sierra Wireless, if it gets put to us in June, will be $15 a share. We could buy it today in somewhere in the 16s, or sell this put at 17.50, subtract out the 250, and our net cost will be 15. It's a buck and a half cheaper than it's trading today, just by doing this simple maneuver. If you do this over and over again, let's take a look at, see how big I can make this calculator. Hopefully you can see that calculator. So 17.50 divided by 2.50. Oh, that's horrible math. That's a 14% premium. Let's suppose that the price of Sierra Wireless goes above 17.50 by June, which is a very real possibility. That means that for April, May, and June, so about 3 months, we earned 14%. Let's annualize that. We're just using rough numbers here. Let's annualize that. Would you be comfortable making 57% a year annualized? Right? I would. And you can take a look at all of these options, right? Antero, 5% in 6 weeks. So let's just say times 8.05. Annualize 40% here if it does not get put to you. And about half the time, these are not going to get put to you. So you just go through all of these. And if you do this 3-4 times a year, and you keep dropping several percentage points every time to your portfolio, you're going to make a lot of money. Now, why does this work out this way? Very simple. And I said it to somebody in here in the chat room, is that pros sell options regularly and buy them occasionally. Amateurs buy lots of options and never sell options. So they're always paying a premium. Paying. Wouldn't you like to be the house? Right? Wouldn't you like to be the casino? Casinos always win, except some of Donald Trump's casinos. But, casinos generally win. Why? Because they're taking in small amounts of money over and over and over and over and over again. And they build some pretty nice stuff with that money. Every now and then we'll want to buy a call because there's something we like and we want to get leverage on. So that actually was a question. Somebody said, why don't we sell a put and buy a call? And I actually do that all the time. I mean, that's in there. We sell all these puts and then maybe buy some of these calls. Now, I typically buy leaps because they're easier. But if you really want to manage the money that you're spending on time value, the time value of the option, it is actually usually better to roll your positions regularly versus just buying long-term calls. And as far as selling long-term puts, somebody asked about that. You never want to sell long-term put. There's too much that can happen, and you just want to keep those time frames short. And the reality is, and I forget what exactly was asked. I know it was in here. Somebody asked about selling a long-term put. No, you're better off selling a put to May, and then another one in August, and then another one in January, than just selling the January one today. The time value will work in your favor. So if you sell 3 puts over the next 9 months on a position versus one longer dated put, you'll make more money selling the 3 puts. All right, let's run to some questions before I jump into the stocks. John wakes up with his angry juice. Tesla will be at 0 in 6 months. Okay, we'll talk about Tesla. I haven't talked a lot about Tesla, but we'll talk about Tesla. I'll tell you what's going to happen with Tesla. I've actually gotten that one right several times, and I just haven't had big enough cojones to make the bets. All right. So let's talk about GameStop first. GameStop is getting clobbered. And it's because the last management really wasn't very good. I like the new management. I think that they're going to be fine. So here's the thing with GameStop. Technically speaking, they've been getting crushed for 3 years. Bam, 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 bam. That is a short seller's dream, that chart. However, when you look at their fundamentals, oops, yeah, it's the wrong CH. But we're waiting to see. See that money flow? Bottomed out. Money flow is starting to pick up. Somebody's starting to nibble on this stock. So if the money flow keeps going up, this is a technical indicator that'll tell you that somebody's getting interested in this stock. So what you want to see as a long is for this shaken money flow, which I think is a good indicator, which is why I use it. I think you're going to see money flow go up. Now, let's take a look at this order just last 5 days. Look at that. Last 5 days, somebody really started buying GameStop. Let's take a look at this order 2 days. Right? It's jumping. Somebody's starting to buy this stock. I think that GameStop is near a reversal. This is just one of the quant systems I use. I use another one that's a little bit more comprehensive, but I have to change all kinds of things in it, and I don't like doing it. GameStop, extreme reversal candidate. So when you get to the extremes, generally going to flip around. I think that GameStop right here, maybe it opens up down on Monday, but then turns around. I think that we are finally at the bottom for GameStop. Now, about the company. Some things that you need to understand about the company. One, they're profitable. They make money. They're trading for less than book value. Now, you can quibble with what book value is, but they're either trading at or below book value. Their debt is not very high, right? So everybody here has the narrative that GameStop is going to hell in a handbasket because they're not selling as many used video games. And that's true. Their video game business is shrinking a little bit on the used side. But here's what they have growing, is they have a collectibles business that is growing, and I think that collectibles business is going to keep growing because they're changing their business model a little bit. And they're doing something that I talked about on one of their conference calls. There was a Q&A. It didn't make the tape, but I brought up, I said, hey, why don't you guys really make a push into virtual reality gaming and close your teeny tiny stores and have fewer but bigger stores where there's gaming, and you have gaming in the middle of the night. You have let the kids come in at after business hours at 9 and 10, 11, 12 o'clock at night and do virtual gaming in return for signing up for your service. Why wouldn't you do that? So they have an unusual ability, I think, to compete hugely in the download space for games. And they can do that by leveraging their floor space for virtual gaming. And I think that that's coming, and I think it's a big deal. Now, they are moving away from the some of their technology division with AT&T and those stores. I think those stores are all going to get sold off. I think Spring Mobile and where my son works are going to get sold off. Why? Because the cellular business is a very slow growth business, and it really just relies on churn. So I think that you might see GameStop just sell off all of those assets and go back to being a pure play on gaming and then the collectibles. I think the collectibles and the gaming go hand in hand. So I think that that's what that business ends up being. I think they're just going to sell off the Spring Mobile and take it as a, hey, we tried it. There just isn't a lot of reason for them to be in a business that has such thin margins. With AT&T saying, hey, every time we make less money, you're going to make less money. Well, there you go. Why deal in a mature business? Gaming is never mature. Why? Because there's always new kids. And I think the virtual gaming is going to be huge. And if they can take some of their smaller stores and close them, and maybe even move into some of those empty Kmarts and empty Walmarts and empty grocery stores that are all over the country, and I drive all over the country. I drive 30,000 miles a year all over the country looking at stuff. They can create destination stops where you say, hey, I want to check out this virtual gaming. Where can I do it? Let's go to GameStop. And all you have to do to try it out is sign up for their service. Maybe a lifetime fee or something. I don't know. They'll figure it out. And I think that's the way it's going with GameStop. And like I said, remember, they're still making money. They've got a PE ratio of, 36 here, but forward looking, let's see, where's the forward looking? I can get to that. But, they're not just going to keep losing money as far as marginal decreases. They're going to start to see some growth, right? So here's the marginal decrease right here. I think you're going to see this company survive. This is not going the way of Radio Shack. Now, should you put 30% of your money in it? No. You put 2-3% of your money. You hope that they can keep their dividend yield. I think they can because they're strong enough financially to do it. If they sell off Spring Mobile, now all of a sudden, I think they're in pretty good shape. So that's the thesis behind GameStop. I just think that the narrative about them slowly dwindling away is wrong. We know that they have big growth in the collectible space. We know that they still make money on the used games, and the download space is growing, and they have a way of growing the downloads better than anybody else because you can go there and test it. If they go that route, if you see an announcement and say the next 90 days, that's a hint. I think the announcement's coming in the next 90 days that they're really going to make a push in the virtual gaming, virtual reality. Then you're going to see a lot of people get excited about this stock again. Now, can it go back up to 60? I don't know. But I think for sure into the 30s. And in the meantime, you collect a dividend. Subscription revenue, that's what I do now. Tell you, subscription revenue is pretty cool. Even though I don't charge half what I probably should, it still piles up. So keep that in mind. I think that's GameStop's future, subscription revenue and collectibles and selling off everything else. CenturyLink. The question I have is, I don't doubt that there'll be the better management equals better results, and that's from the level 3 management coming in. But with the convergence of cable, phone, cord cutting, will they be swimming upstream? No, I actually think that's the exact opposite. I think that AT&T, Verizon, and CenturyLink, and Comcast are all going to do really well in this future. Why? Because they're all going to charge more for the pipe, right? So AT&T, I think, I don't think they need Time Warner, right? I don't think they need them because wherever you are in the country, you only have 1 or 2 or maybe 3 options for how your internet service gets into your house or business, right? It's going to be an oligopoly no matter what because there's enormous barriers to entry. Nobody can build what CenturyLink has now. Nobody can build what Verizon has now. Nobody can build what AT&T has now or what Comcast has now. And those industries have been going through consolidation. CenturyLink level 3, a couple other little acquisitions. AT&T's bought a couple little things. Verizon's bought a couple little things. At some point, you'll see the what are they called? CLECs. You're going to see some of the, countryside little telephone companies and cable companies consolidating more of that. So while you can go ahead and cut your cord all you want, I'll tell you what, and I've done it. I don't have cable TV anymore. I just have an $80 a month pipe into my house so I can get fast everything online. You're seeing a change in the model, right? If you think that you're going to get internet service for $40 a month and get fast internet service, think again. So as companies like AT&T and whoever else get less money for one thing, they're just going to charge you for the thing that you're using. And that's how it'll be. And it'll probably be easier for them to do it because now they don't have to have as many service people on all the other things. So if a company like AT&T, which is getting close to a buy point for us, is able to charge you for your cell service and your internet, what do they care if you have a landline? Seriously, what do they care? Right? They know that because you have your internet with them that you're pretty sticky. If you have your internet and your cell, you're pretty sticky. Now, will the day come where the government pushes for more competition? Sure, it won't matter though. They're still going to have to use the wholesale services of these other companies. So, I wouldn't say that anybody is going to start losing money because it's not that competitive, and that's the point. There is not a lot of competition in these spaces. You only have a couple choices when it comes to how to get your internet. And eventually, you're going to have fewer choices on your cell phones, too, because there's massive consolidation coming there. One of the reasons that U.S. Cellular is on our list is that I think that that's a company that is going to get bought out. It makes all the sense in the world to me that T-Mobile or Sprint would buy U.S. Cellular. Sprint's more aggressive. It makes sense for them to do it, but we'll see. So I like CenturyLink. I like the big fat dividend. I think they're probably going to be able to keep the dividend, but even if they cut it in half, it still would be a 6 or 7% dividend. I don't think that would impact the stock price at all because I think everybody already figures that the dividend's going to get cut in half. So there really isn't a whole lot of downward sentiment on that one. And guess what? I bet. So they're still in the sell range, but they just came off of one of these extreme turnarounds. So they have that bounce. Now they're coming here, but they're heading from left to right. Okay, that's when the line's going up. They're heading from left to right. So they're moving towards being a trend followers buy. So right around here, the trend followers will start to jump on. So if this goes up to 17-ish, maybe close to 18, that 17 to 18 range, now it goes from a sell to a hold to a buy. So I don't have the reversal system built into this one. I eyeball it. But the reversal system would have said to buy down here. So I think that you're in pretty good shape. Now, if the stock bounces down like that a little bit, go ahead and buy it. But I would, if you don't own CenturyLink, I think you're missing out on a big fat dividend and a company that as they grow their revenue, which is sure to happen, things are not bad. Look at these numbers. These are not bad numbers. They have a little bit too much debt. But, you take a look at AT&T, not that much more debt than AT&T. And AT&T has that huge pension to deal with. Take a look at Verizon. Verizon's the one I don't like. Look at that debt. And frankly, I've talked to quite a few Verizon people because I know them out east. Verizon doesn't treat their people all that great. I think they have a comeuppance coming on that. So, I like AT&T. I like CenturyLink, and I think that those are both companies that you can do well with. AT&T, we needed to get down a couple more bucks. I'm not going to quibble. This is a good looking box right here. That is a good looking box right there. It's consolidated. Now, I thought that it looked good over here too. So, I did get out and get back in a little early. I'm in at about 18. 18 seems to be where it'll probably break out. So if you're buying it down in here, I think if you're patient, you're going to do pretty well. I think 30 something is pretty likely. That's where it's going to hit some resistance right around 30, 32, right in there. Take a look over here. But once it breaks through, now you can go all the way up into the 40s. But let's suppose this ends up trading in a range along with Verizon and AT&T, and it just trades between 30 and 40 for a long time. Well, the ride from 16 to that range is pretty cool, and you're getting that dividend. And by then, it'll be a much more stable company. So, and by the way, they're a takeover target. It clearly somebody for all the services this company offers on the business side, and the infrastructure that they have. I could actually see Google spinning out a company when they do the baby Googles, and CenturyLink being part of that deal. All right. Tesla. Some of the technology stocks are close to the 50-day moving average. I am being more conservative on that, so I'm looking more at 200-day moving averages. I do have this ranked right now in relation to what I call the strong support. So companies in here. Impinj, really is kind of on probation for us. I just don't know if they're going to turn it around. I think they are. I haven't done a real deep dive into it lately. I'll take another look at them soon. A company that I'm probably going to add to the very short list shortly is Himax. I used to follow Himax, and I think Himax probably has some potential, so you might see them on the list soon. I'm not terribly worried about this 50-day moving column, 50-day moving average. And take a look at the 200-day, and stocks that are closer to 200-day, go ahead. Like Impinj is way below, right? Because they just got crushed. But you take a look at, where's Qualcomm on here? Well, Google. Theoretically, you could be buying Google right now. It's real close to its 200-day moving average. If you don't own any Google, and you just want to put 0.5% or 1% for a starter position, those prices just above 1,000 are pretty good. And then there's some step ladders down at 960 and 830 on Google. Where is Qualcomm? The reason I bring up Qualcomm is I've been studying them a little bit more. And I think that Qualcomm is a company you might want to take a look at here soon. All right. Sort range. Column C. Oh, what did I do? Column B. Column C. I don't know why that's not working. But in any case, Qualcomm, they've been in the news a lot. Lawsuits, losing business, gaining business, mergers, takeovers. Every time they get down to this area, right around 50-ish, 50-something, they seem to bounce back up. And they pay a pretty good dividend. Their debt to equity is fine. They do have some problems with shrinking margins, but I think in this smart everything world, I think Qualcomm remains a takeover target. I also think that they are a likely merger candidate with somebody. Them and Micron seem to make a lot of sense to me. So I'm going to ask Eric what he thinks about that. But I'm starting to warm up to Qualcomm if you're looking for a dividend stock, right? So if you're looking for a nice fat dividend stock that can offer growth in the intermediate term, I think Qualcomm should be high on your list. Oh, I see what I did. Okay, I understand what I did. There we go. That's what I wanted to do. All right, so you got Qualcomm here. They're below their 200-day moving average. They seem to be holding it. It wasn't good that they closed the week below their 200-day moving average. So see where they are next week. But if this stock drops down into that, yeah, man, if they really start pushing 43 and push into the 40s, I think it becomes a must own. And you just suck it up and say, well, I'm going to wait while that 4-something dividend pays me, and I'm going to wait for whatever strategic transaction comes. Because there is a strategic transaction coming with Qualcomm. We don't know what it is, but it's coming. And strategic transactions generally work out pretty well. Sierra Wireless, again, it's been holding. It's been in that big downtrend, but it seems to be flattening out right now. And I think that you could actually buy this stock right here at 16.50. I like selling the puts just because the premiums are so huge. All right. Yeah, I think brick and mortar is good for the gaming business. Why? If you want to try, have you played virtual reality games? So I went to a place in Tempe, Arizona, with my kids, and there was a virtual gaming center there. It was pretty cool. Imagine if GameStop has virtual gaming in their stores where you can test out the games, and they somehow hook it into getting into their download business, right? Fewer stores, more traffic, more downloads. Yeah, I think the bricks and mortar. I mean, why do you think Amazon is looking into buying some stores? There is a reason to have bricks and mortar. And the problem with bricks and mortar versus online, it's not that online was the newest biggest thing. It's that it was the newest biggest thing, but the bricks and mortar didn't adapt. The bricks and mortar stores that have good online presence do just fine. But you had all kinds of bricks and mortar that never adopted a good online presence, and they got screwed. What happened when Best Buy changed their business model and beefed up BestBuy.com? Best Buy is doing really good. So I think GameStop could follow a similar strategy as Best Buy. In fact, I could even see a deal between them two. The rule is sell a stock when they're bought out, right? Not always. Depends. Mergers are good. A lot of times mergers result in synergies that do very well. So, Potash and Agrium. When that deal got announced, we didn't sell that. Now we own Nutrien. You recommend Diamondback and Centennial. Yeah, they're not on the very short list. I don't think they're priced perfectly, and I think that we have a lot of energy exposure. So what are we going to get rid of? Are we going to get rid of Occidental or Encana? How much energy do you want? So if you want more energy stocks, I think that Centennial and Diamondback are the best of the Permian pure plays. And I think I think Centennial is probably the better one. That's the one that's more likely to go on the list. So we'll see. Yeah, I might add those, but with a caveat. Thoughts on Broadcom? Don't really follow them all that closely. I don't know what Mike. What are your thoughts on Broadcom, Mike? Bargain. Yeah. Is this right? That's not right. This is right, isn't it? They call it B Communications. Oh yeah, I was gonna say that's not right. That's right. There we go. I don't know why it didn't come up when I typed it in. Yeah, I haven't really looked at this all that much. I don't know that it's a bargain. Yeah, I don't know. Price to book 3.7. I don't know if that means anything. PEs often drop because there's an expectation that earnings will drop, right? So that's the question with them: is are their earnings going to drop? Why have they been so acquisitive? Are they making all their money through acquisitions? And what happens when those acquisitions get to be too expensive, or they don't merge in quite as well as they should? I don't know. I'm just throwing those questions out. I don't know a lot about Broadcom. Yeah, I know that Intel has been rumored to be looking at Qualcomm, and that makes sense to me too. Yeah. Tesla is going to zero, somebody says. Here's why Tesla's not going to zero. Because, as I said, do I even have them on the on this list? Yeah. Oh, yeah. Here they are. So, I've had Tesla down at $150 target where I'd start looking at buying it, even when it was at $350. I'm telling people $150. Here's why: they have tremendous support in that $150 range, and this idea that they're going to run out of money is so stupid. It's kind of astounding to me. Every time that they need money, see, look at this, 175. Got down to 150 once, 142. And what's funny about this trade right here, where it was 142, over at Fundamental Trends, I actually had people put in a limit order at 150, and that's the only time it ever filled. And there's only like 3 people that bought it, because people have a hard time buying stocks when you're looking for a reversal. But he rolled it all the way up to about here. He just this little trade. And he rolled from like 150 to 185 or something. So a nice couple month gain. So Tesla, and I haven't written the article, and I should have, but now it's probably a little too late. Tesla is a hard short for a couple of reasons. One, the future is electric vehicles and hybrids. So they're going to sell a lot more cars. Second, their solar business, although it's chopping along now, will end up being fine. Probably end up being a big deal. They're probably going to be the number one solar company for residential homes in the 2020s. And what do we know about residential homes right now? There's a shortage. So there's going to be a lot of solar roofs put in during the 2020s because the price of solar is just coming down that fast. Third, the storage solutions are going to get cheaper and cheaper and cheaper. And lithium is gonna come down in price probably by half, if not more, just like silicon did. And so the question for Tesla becomes, can they wait it out? Can they get by for 2, 3, 4 more years? And I think the answer is unequivocally yes. I think that this box, right, this is where their trading range should be, in the 100s, maybe up, 150 to 250. So they're going to break down into this new trading range. Are they going to zero? I know Montana Skeptic makes a living just bashing Tesla, but the idea that more great news about Tesla. John, you're just wrong. I mean, I'm just going to tell you flat out that you're wrong. Tesla has the right technology. They're at the front end of a lot of things. All they need is a financial bridge. That financial bridge is easy for them to get. This idea that they're not going to be able to borrow money, big deal. If they can borrow money at 6, 7, 8%, they'll be fine. All the oil companies did it. Do you really think that Wall Street is going to lend to the oil companies that they know are going to be gone in 20 or 30 years versus Tesla, which might become the biggest company in the world? Yeah, that's right. Tesla might become the biggest company in the world. How could that happen? We already know that they have a working relationship with China. We already know that they have a working relationship with India. Do you think for a minute that China and India aren't willing to buy 5% of that company in return for a factory? If you think that's the case, you're not paying attention. It's already happened, and they didn't even get a factory. So China, Tencent, already bought 5% of Tesla. Do you think that they can't dilute this stock by 30 or 40 or 50% and have all the money they need to bridge on over? And that's what I've been expecting. They're going to dilute this stock. They're going to get all the money they need. In return, they're going to get penetration into giant markets where they don't want to have internal combustion engine vehicles. Now, it's going to be tougher for them to break into Italy, or not Italy, Europe. I was looking at Italy on my screen. Why? Because they have all those car companies over there. But India and China, Tesla's going to end up in both places, and they're going to sell a lot of cars, and they're going to get the $10 billion or whatever it is they need, or $20 billion. Now, does that mean the stock won't go down? No. I think it's going to dilute. I think it's going to dilute by 20, 30, 40, maybe 50%. And then you're going to have to take a look at a rational expectation of how many cars they could be selling 5 and 10 years out. And I think that they can get to be as big as Ford and GM. Frankly, there's nothing about GM that impresses me. So you take that for what it's worth. GM is needed to be bailed out once before, and I don't think they're all that strong now. All right. Any other stocks? We're going to call this a day. It's, like I said, started 30 minutes, then an hour at an hour and 15. And I'm starting to get coffee again. All right. All right, we're going to call it a day. Happy Good Friday. Any other questions, go ahead and send them via the chat or the forum, depending on which website you're on. And, keep in mind that the market is getting volatile. But the big trends are the big trends. And the central banks are going to do what central banks do, and the government's going to do what the governments do. Tesla, you get it around 150. That's probably a good spot. You have to keep an eye on what the dilution is. Could they go all the way down to 125? Maybe. I don't know. Could they go all the way down to 75? Yeah, maybe. I don't know. But let's keep an eye on the dilution. They're not going to disappear. The amount of money they need isn't quite as much as people make it out to be. And they have an awful lot of people with deep pockets around them. So, one of the best buys might be to buy Tesla, the first priority bonds. So, if you think that maybe Tesla does have to reorganize, fine, buy the first priority bonds. This company will not disappear. Financially, they're going to have to do some things, but they will not disappear. All right, you take care.